If you've been holding gold, silver, or shares in top financial companies, you might want to take a deep breath. In just 48 hours, the precious metals market didn't just dip, it absolutely tanked. Gold prices crashed by a staggering 6,000 rupees per 10 grams in just 2 days. Silver took an even harder beating, plummeting 15,500 rupees per kilogram. The shockwaves instantly hit Dalal Street, wiping out millions in market value for India's top gold loan companies, Muthoot Finance, Manappuram Finance, and IIFL Finance. Let's look at the raw numbers. Gold dropping 6,000 rupees in 48 hours is one of the sharpest short-term corrections we've seen recently. Manappuram Finance shares tumbled nearly 3%, sliding to around 309 rupees on the NSE. Muthoot Finance and IIFL Finance weren't spared either, both shading over 2% in a single session. Silver, traditionally more volatile because of its industrial use, took an even harder beating. If you are an investor, this looks terrifying. But to understand why this happened, we have to look across the ocean to Washington, D.C., and the story of the US dollar. Every major market crash has a hidden mastermind. This time it is the US dollar. The dollar index, which tracks the greenback against 6 major global currencies, just climbed to a more than one-year high, trading around 101.5. The dollar is heading toward its sharpest monthly gain in almost a year. Why does a strong US dollar kill gold? 2 reasons. First, gold is priced globally in US dollars. When the dollar strengthens, gold's price falls. Second, opportunity cost. Gold pays zero interest. The US Federal Reserve is signaling a hawkish stance, raising interest rates to fight inflation. Big investors dump gold and chase those higher yields. Think about it from a big institutional investor's perspective. If US government bonds start offering higher guaranteed risk-free interest rates, why would you keep billions in gold that yields nothing? You dump gold, buy dollars, and chase those higher yields. That massive shift is exactly what we are witnessing right now. Now let's connect the dots back home to India. Why are companies like Muthoot, Manappuram, and IIFL falling just because gold prices are dropping? It all comes down to LTV, loan-to-value ratio. When a customer pledges gold, companies can lend up to 75% of the gold's current market value, as per RBI regulations. Here is the nightmare scenario. If gold prices drop too fast, the collateral value in their vaults plummets. If a customer defaults, the company cannot recover their money even by auctioning the gold. To mitigate this, financiers send urgent margin calls to borrowers, pledge more gold or pay down the loan. This operational stress spooks investors. That is why stock prices dropped. So where do we go from here? 3 strategic takeaways. First, don't panic sell. Corrections like this are vital for a healthy market. Gold had a massive bull run over the last couple of years. A sharp pullback on Fed commentary is completely normal. Second, watch the dollar index at 101.5. If it surges past that level, expect more downside on gold and silver. Third, the opportunity in NBFCs. Well-managed gold loan companies like Muthoot and Manappuram have incredibly strong risk management frameworks. A temporary 3% dip might offer a solid entry point if you believe in their long-term business model. Precious metals have survived every central bank policy change in history. The fundamental value of gold hasn't changed, the macro environment just got noisy. Drop your thoughts in the comments, hit like, subscribe, and keep tracking those charts.